Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Suncor stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Suncor's specialty is the production of synthetic crude from oil sands, which is just one of many ways to extract oil. The sand is removed from the ground and put into trucks, which then bring it to crushers where the large clumps of earth are processed. Once the oil sand is crushed, hot water is added so it can be pumped to the extraction plant. Most oil used in North America comes from shale rock. The rock is extracted from the earth, then crushed, then heated to release the oil. It was selling retail gasoline at Sunoco in 480 locations until it acquired Petro Canada in 2009, and it changed all of its Sunoco gas stations to Petro Canada. Sunoco branded gas stations can be found all over the United States, but those are owned by Energy Transfer. Suncor is a fully integrated oil company that pulls oil from the ground, which is the very first step of the process, and sells oil directly to the retailer, which is the last step. Its renewable energy division includes interest in 4 wind farm operations in Ontario and Western Canada, also the 40-mile wind power project, which was restarted in early 2021 and is currently planned for completion in late 2022, after it was temporarily paused. In 2020, the company increased its investments in clean technology. This includes LanzaJet Inc., a company working to bring sustainable aviation fuel and renewable diesel to the commercial market, and also the Varennes Carbon Recycling Facility, a biofuel plant in Varennes, Quebec, that is designed to convert commercial and industrial non-recyclable waste into biofuels and renewable chemicals. The company is also one of the largest Canadian retailers of petroleum products. It is headquartered in Calgary, Alberta, Canada, and was founded in 1919. Alberta is one of the largest producers of oil on the entire planet, and this company is a big part of that. You can find the stock on the TSX, New York Stock Exchange, Mexican Bolsa, Deutsche Börse, and Swiss Stock Exchange. We're going to look at the ticker that trades on the TSX, since all the numbers on their financials are in Canadian dollars, but it also trades in the US. The ticker is SU. Let's get started with the model. This is a large cap company, 43 billion market cap. They're trading at $29 a share, and they have 1.5 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do have positive and healthy free cash flow every year except 2020 because oil prices were so low that year. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that looks really good except for 2020. Revenue is the sales for the company, and that was really high in 18 and 19. It took a major dip in 2020, but it is coming back in the trailing 12 months. Let's look at their financials. The top line is the revenue, the sales. Here's a breakdown of their 19 and 20 revenue by country. Canada is their biggest revenue generator, then the United States, then other countries. And it was highest in 2019, and then it dropped in 2020. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that was high in 2018, low in 2020, but it's more than double from 2020 to the trailing 12 months. Below that is their operating expenses, and then their operating income, which was positive every year except 2020. They do have a good amount of debt, so they paid $1.3 billion of interest on their debt. And the bottom line of the income statement is their net income, which looks good every year except in 2020. This chart is from Yahoo Finance, and it consolidates a lot of the information. So sometimes it's good to look at the company's annual report to get a little more detail. So this $18.6 billion in cost of revenue, that's a combination of these two numbers, $9.1 billion and $9.5 billion. $9.1 billion is purchases of crude oil and products. These are the expenses in order for the company to generate the crude oil. This includes employee payroll and all the expenses to extract the oil. They also have $9.5 billion of depreciation, depletion, and amortization. They buy a lot of expensive machinery and equipment, and that's carried on a balance sheet and depreciated over the useful life of that asset. And the $11.5 billion of operating expenses, that includes this $10 billion right here. That's operating, selling, and general. That's payroll, marketing, and other expenses. And transportation is a big expense because you have to get to and from locations. You also have to deliver the products to the customers. That's $1.4 billion. And then some other smaller expenses. I like that they broke out their tax provision, the $1.8 billion, into current and deferred. Current is the taxes that are due. Deferred is carried on the balance sheet and will be paid sometime in the future. If this was a U.S. company, deferred taxes would be the difference between what GAAP accounting calculates and what the IRS calculates. Since this is a Canadian company, it's a difference between the way a Canadian corporation calculates taxes and the way the Canadian government calculates taxes. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash because net income is your accounting profit or loss. It's not actual cash. So you can see they generate lots of cash flow each year, even in 2020 when they had a loss. Because there's lots of non-cash items that get passed through onto the income statement that bring down your net income, but they don't affect cash flow. If you're investing in a company, follow the cash flow. That gives you almost all the information and it's much easier to follow. If you try to understand all the accounting rules, it can get really confusing. They spend a good amount of money in CapEx each year, $4 to $5.5 billion. Operating cash flow minus CapEx gives you your free cash flow. And they do have positive each year except in 2020. So it looks like they've been reducing their debt load, $1.4 billion in the trailing 12 months. And they also buy back a lot of stock, $3 billion in 2018, $2.3 billion, $300 million, and then $1 billion. When a company buys back stock, that decreases the shares outstanding, making your shares more valuable. That's a great way to reward investors. Another way to reward investors is to give a dividend, and they also give a dividend as well. So when you invest in a company that has lots of free cash flow, they have the ability to give a dividend and to buy back stock. Let's look at the capital structure. $36 billion of equity, $21 billion of debt. They're 64% equity, 36% debt. And their weighted average cost of capital is 8.8%. That's the middle whack according to Finbox. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for that $64 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $58 billion. We divide that by 1.5 billion shares. And we get a calculated stock price of $39. They're trading at $29, so they're trading at a 26% discount. It's a buy according to the model. The average analyst projects their revenue to grow 2.3%. I grew their revenue 2.3% for the next 4 years. The way I calculated their future free cash flows, I needed to see what percent of their revenue they convert to free cash flow. So I summed up these 3 free cash flow numbers. I excluded 2020 since it was negative. And I divided by these 3 revenue numbers, excluding 2020. And that came out to 12%. So they convert 12% of their revenue to free cash flow. I multiplied their future revenue numbers by 12%. That's how I got these future free cash flow numbers. You can do all the analysis in the world, but if the price of oil crashes like it did in 2020, you're not going to make any money by investing in this company. If the price of oil is $60 or above, you'll make money. If it's over $100 like it was at one point, you'll make a ton of money. If it's below $40, you're not going to make any money. That seems to be the break-even point for a lot of these companies. I think the only company that can make money when oil is below $40 is Saudi Aramco, because it's so inexpensive for them to generate oil. Oil is not going away. It pretty much has been increasing 1% a year for a really long time. And by 2025, they don't expect it to increase 1% a year. It should be increasing 0.5% a year. That's the projections. So it's definitely not going to go away. EV cars are such a small population of the total cars out there. By 2050, it's expected for the number of EV cars to just equal the number of regular cars. There's so much reliance on oil, don't worry about renewable energy affecting this stock. Probably not for a long time. Simply Wall Street values the company at $45 a share. They're saying it's 36% undervalued. 11 analysts priced this stock and the average price target is $29. This is for the stock that trades in the US, not the stock that trades in Canada. The stock has done pretty well the past 52 weeks. The stock was trading over $30 a share back in June. It came down to about 22, but it's coming back up recently. Generally, the stock price moves with the price of oil, and these Ds are for when they pay a dividend. Their dividend is 2.9%, which is 82% of their net income, 51% of their free cash flow. So they should be able to afford this dividend in the future, possibly raise it. Their industry pays a higher dividend, 4.1%, but analysts are projecting this company's dividend to grow to 3.6% in the next 3 years. This is a pretty volatile stock. It has a beta of 1.96, so the stock moves about 2 times the market. It's gone up 75% in the past 52 weeks, while the S&P went up 25%. The 52-week low was 14, the high was 38, and the stock is trading above its 50-day and 200-day moving average. About 8 million shares are traded each day on this stock. All the shares outstanding are on float. 72% are held by institutions, and 2% of the shares are shorted. Analysts are projecting their earnings to grow 12%, but their revenue to grow only 2%. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $11,000 today. That's only a 1% annual return. Sometimes when you invest in a stock that's linked to a commodity, you really have to time it well. If you bought into this stock when the oil prices were really low in 2020, you would have made a great return already. The biggest shareholder is Dodge & Cox, then Fidelity, then Vanguard, Fidelity International, and RBC Global. Let's look at their financial ratios. Their PE is a bit high at 28. PE is stock price over earnings per share. They have a good price to sales at 1.4. better than the market median average, and their price to book is also really good, better than the market median average. Their return on invested capital is only 3%, but this is the trailing 12-month number, which is the second half of 2020 and the first half of 2021. Their numbers should improve a lot as we get closer to completing 2021. They can only cover their interest payments 1.3 times with their operating income. I like to see at least 2.0. This is something you want to keep an eye on. I don't think they're going to have problems paying the interest on their debt, but I don't like it when a company gets this close to 1. They have a low ROE at 4%. Their current ratio is 1.0, but their quick ratio is 0.6. They have $2 billion of cash on their balance sheet, $4.5 billion of receivables, and $4 billion of inventory. The company does seem to have enough capital to get through the next 12 months. They had $2.4 billion of free cash flow in the trailing 12 months, $441 million of working capital, and they paid out $1.2 billion in dividend payments. So they have $1.6 billion of funding. The best way to look at ratios to compare them to companies in the same industry, I've done videos of 8 companies in the same industry as Suncor, and if Suncor has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're better than average in PE just because a couple of companies like Cenovus and Chevron have such high PEs. They're really dragging up the average. They're a little worse than average in price to sales. They're better than average in price to book. They're a little worse than average in current ratio. ROE, they're low, but they're better than average because a bunch of companies are negative. They're a little higher than average in debt. I converted all the market caps to Canadian dollars, and they're a lot smaller than average because there's some really big companies in this industry like Exxon and Chevron. And they don't pay a small dividend, but it is smaller than the average. So to summarize, I have them trading at a 26% discount, and oil and gas has always been a pretty safe investment. You get that guaranteed dividend, and when you invest in a company this big, there's not too much risk of default. And they are pretty prominent in Canada. They are a bit small compared to some of the monster companies in the United States. But I know this is a really important company in Canada, and a lot of Canadians are invested in this company because of how long they've been in the country and how many jobs they supplied, and oil is a vital commodity. So I definitely think it's a long-term play. Even if people keep saying renewable energy is taking over, I would ignore those people. We are moving towards that, but it's going to be a really slow transition. It's going to take many, many decades for renewables just to be equal to the regular oil and gas stuff we use. I rank their free cash flow 7 out of 10, their revenue 7 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.